The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we take a look at Wednesday's market action, I've said this earlier, kind of the same theme we've seen all week long as we saw pressure in wheat, soybean oil. Soybeans did work off their lows. Corn kind of firmed a lower, mixed in cattle and hogs. It just felt like a slight risk-off type of trading day on Wednesday. We're going to talk through things, though. Joining us for market analysis and perspective, Mike Zuzolo with Global Commodity Analytics is with us. And Mike, good to catch up with you. I know I'm just down the road from you in Kansas City here today, and I appreciate you getting us some time here to be on the program once again this week.
Well, congratulations on the farm launch. Looks great, Jesse and all the crew there. Really nice looking outfit, it looks like.
Yeah, I appreciate that. Launching Farm and Ranch Media, our umbrella brand here today for Market Talk, and our sister brands, AOA and American Ag Network. So glad to get that off and running, and hopefully we'll see you this week. I know you're a little under the weather, Mike, so I know you're contemplating making an appearance here in person in Kansas City, and if not, we totally understand. Let's talk markets. 1,000-foot view this for us here as we kind of start off. It's felt like it's just been a down week all week in grains, wheat, soybean, oil, et cetera, et cetera. I mean, what's your thoughts overall, Mike?
Yeah, dual track negativity is probably the best way to classify it from way high above the clouds right now, Jesse. And we've got a dual track negativity coming from the disappointing Chinese stimulus, which has ignited the dollar, which I think is representative of mostly why the wheat market has taken the leadership to the downside roll. Hard red wheat today on Wednesday, 5 days down in a row, getting very close to that $5.12 low from earlier this year, which was also a 4-year low. So we really got to be watchful and on the ball with that. And so Chinese stimulus, I think, working into the wheat market primarily through the copper, through the crude oil, a lot of things we've talked about in the past. The corn and beans seem like they're kind of coming into more of a biofuel play, and maybe a little bit more of what's happening when it comes to the new Republican mandate, as they have taken both houses of Congress and the White House. What we saw Wednesday, I think, was a little bit of a piece of the overall puzzle, in that around lunchtime, midday, we saw a really big shift in short covering in corn and beans, and it just happened to be pretty simultaneous with the announcement that Senator Thune from North Dakota, big energy state, is going to be taking over the lead of the Senate from the Kentucky Senator Mitch McConnell. It seemed like corn and bean markets really like that a lot. So this dual track, I think, is really critical to keep an eye on.
Yeah, Senator Thune, South Dakota, by the way. South Dakota, yep. But, you know, it's all of that said, and looking at just more election fallout and more here, and you brought up China. Let's start there and take a look at our first chart. And I know this is looking at their food CPI versus the pork price, but I mean, obviously you got elections in one bucket, you got weather in another, but we've been following these economic issues in China with you for a while now. So walk us through some of this, Mike. What are you seeing?
Yeah, and you know, they've made about 4 announcements now, Jesse, since the end of last year, beginning of this year, and they just haven't turned the corner in terms of getting the financial market to believe that they're going to be able to spur their domestic consumption quickly. All the things they've put out are going to take time, and that's what's been so disappointing. So what we have here is pretty brand new CPI data, PPI data from China. Got new CPI data from the United States this morning, by the way. But this PPI, CPI issue with the Chinese is not going away. We talked about it, I think, a week or two ago. What we see in the food CPI, the yellow line, is it curled down again. It went down another 0.4 of a percentage point to 2.9%. This time it was helped lower by the pig price. And so we're not talking livestock right now, but this is a nice chart to keep in the back of your mind as we progress into the holiday seasonals and the holiday buying, because the Chinese hog market has been staying very elevated and very supportive of our U.S. markets. And I think they're starting to give way now with some of these new data points that we're looking at. But that pig price, say, for instance, out of Sichuan, Used to be, at the peak of 2020 was $9 a pound, now down to about 207, and it's starting to move down with the overall food CPI, which is not a good sign. And so coming off that WASDE report, we've got a situation now where we've got tightening global supplies, and yet the market's acting like it's the exact opposite. And I would put that at the feet of these Chinese data points and this inflation.
Well, let's talk a little more on the wheat side. Let's pull up an SRW chart versus the dollar. And I know we're getting back down to, it started to look like we're going to test some August lows here, maybe in wheat futures. Talk about what you're seeing overall in this wheat complex right now, Mike.
Yeah, today's video and conversation with you and the audience is really about how do we handle this in terms of where is the next stop, what's going to prevent us or what's going to allow us to continue to see the dollar go higher into the January inauguration, because some in the trade are thinking that now. This chart is an annual chart. The orange line shows you the US dollar index on the left-hand side, 106.52. The right-hand bar chart is the actual soft red wheat price in each year. So what we see on an annual basis at 106.52, that purple and white arrow shows us we're at the highest level in the US dollar index since those big deflationary time periods of 2001, 2002. This syncs up really nicely with what the market's feeling about China. And so China deflation is being pushed into the dollar rally. The election is helping that with some of the picks by President Trump in terms of the market thinking that we're going to be hawkish and really tough on trade with the Chinese. I'm not so sure about that. And I'm going to be writing a couple special reports about that. But the key point here is that on an annual basis, this dollar, while it's only at a 12-month high right now on a monthly chart, if we closed here where we're at the end of December, we'd be at the highest level since 2001, 2002, and that was that peak deflation time period for the commodities. I hope this helps clear up why the wheat's getting dragged down so aggressively.
You're concerned. Thinking about those outside markets too, Mike. Let's look at 10-year Treasuries, and obviously there's been plenty of movement in the equities post-election. What are you watching right now when it comes to Treasury yields?
Yeah, and you brought up the outside markets, and I'll just tell the viewers and you today that on an 8-week basis, we've been talking about crude oil and copper, and the crude oil is still running at about a plus 0.74 with the soft red wheat in terms of price correlation over the last 8 weeks. So 75% positive price relationship. Copper's even higher, almost 90% positive price relationship. So this chart here is what I'm working from a standpoint of what is going to be the major force or push that gives the US dollar that higher move into inauguration, especially given that our CPI data today came in on a core level at plus 3.3%. That means that the Federal Reserve is going to have a really tough time cutting rates now, because if they cut rates too aggressively, they'll actually induce more inflation with a new incoming administration that will be very, very hot under the collar if inflation doesn't go down, because that's one of the big mandates that won the election for President Trump and his team. And so what we're looking at on this chart is the old head and shoulders top in the 10-year Treasury, the benchmark yield. And what we see is we bounced off of a major support level about 3 months ago. We've built up above those price levels and now are testing the major trend line and also the overall head and shoulders top formation. So if we go higher on a monthly basis and say we go from where we're at right now, around 4.45% on a 10-year note, up to about 4.5, 4.55% as we close out the month of November, that's indicative that the bond vigilantes are coming back because the inflation is not going down. That kicks in the dollar higher, and I think that's the best likelihood for why the dollar would go higher into the inauguration. I personally think right now that the Republican election win across the board should be built into the US dollar, and it's really the bond market that's going to create another second wind or second move up in the greenback.
Mike Zuzolo at Global Commodity Analytics, our guest analyst here today on Market Talk. Mike, let's talk the relationship between wheat and corn here a little bit. And in terms of, we've talked a lot about wheat being the leader here. You and I have for the last several weeks. Corn is felt very range bound to me. It's felt just kind of like it's drifting here. Hasn't seen big losses comparatively to say soybeans, et cetera, or the wheat trade. Can you draw any correlation between SRW and corn right now?
Well, we can in terms of the feed side of the equation, and this is our feed spread. And when we go below $1.25 premium on soft red wheat minus corn, especially if it continues to occur in the cash market, which it probably is, and it may even be lower than that right now. We closed Wednesday at around $1.17 premium to soft red wheat. It's now in feed territory, and as it goes below a dollar and stays below a dollar, you'll get livestock feeders to really turn on the feed rations towards the wheat, especially in Asia and Mexico. And so we really got to be careful here. We don't want to overplay these really strong export sales. We had another big hit in corn. I want to say it was almost 27 million bushels for the two export sales that we were announced, one to Mexico, one to unknown again on Wednesday morning. But that's only going to get us so far because the spread really does indicate, and it's got a very good track record of indicating that wheat can become the robber in terms of the feed grain side of the equation and take demand out of the hands of the corn market. We've seen this all too often. And, that's one of those things where I don't mind the corn staying strong for a while, but I wouldn't want this to go on. That's why that wheat's so critical.
Looking at corn, I know we got a monthly chart to take a look at here. And to my point, I felt like corn has been very range bound right now. And I look at some of these formations that are building on this monthly continuation chart. What can we infer from what we're seeing right now chart wise in corn?
Well, I think the big thing to think about right now, Jesse, and I'm getting this from the clients and from people that are calling in, that I don't work with, just asking me questions after shows like what you and I do. It doesn't feel like the corn market is really that strong, but look at where we've come from. We've come from a 360 low. We've gotten up to almost 440. That's going to take a 62% retracement, above a 62% retracement from the highs from the second quarter. And those are the highs from this year. And so we literally made back about 2/3 of what we've lost since hitting that major low in August. But it doesn't feel that way. And that's where I want to bring this up to everybody and show them this chart and say, hey, look, we're running at 4-month highs. Plus, we've gained back 2/3 of our losses from our highs for the whole calendar year of 2024. Let's not lose sight of where we are. And so therefore, if the wheat continues to go lower, I think the beans will continue to go lower with it. And at some point, the corn is not going to be able to fight those two. And that's why that wheat corn spread and that dollar rally and all these things we're talking about are so important, because I'm still light on 2024 corn hedges, but I've put out alerts to, as of today, be ready to let a lot go here if we can't hold these recent support levels if the wheat doesn't turn around.
Let's talk a little bit in the livestock trade as well here, Mike. Cattle, looking at this chart, negotiated cash cattle versus futures. And I know we've seen a little early week cash activity in feedlot country already. I was a little surprised by that. What are you seeing on this chart? What's your take on this cattle market this week?
Yeah, it's not as easy to get a rally in the cattle at this point because we've got more volatility in the feeders through the grain markets and through corn specifically, more volatility in hogs, given that China data we looked at, and given the fact that soybean oil has also been a real negative force in this market recently and kind of joined up with the meal market in terms of being nervous about both China and biofuel policy. We've also had more volatility since the election in Wall Street. So this cash market has leaked. We've gone from about 188, 189 down to about 186 or so. As you said, getting some volume here at midweek, which is nice, but we really want to see some turn in this market. Otherwise, I get very nervous that these other factors that have made the funds so long in the live cattle market and record long in the hog market will want to turn and go short as the seasonals that both of these markets have start to turn more negative as we get closer to the end of the year.
stuff as we think about closing out the show here today. I'll open it up to you. Final thoughts. I know we're weaving a lot of different things together. You're watching a lot of things with your analysis. So to sum this all up, what would you reiterate to folks here today for the markets, Mike?
The key was last week we had a WASDE report that met my expectations of lower supplies. We talked a lot about that. Lower global supplies across the board. Stocks to use levels shrunk in corn and wheat substantially, and we're still at 10 plus year lows. It doesn't feel that way this year, and I put that at the feet mainly of fear of Washington policy and Chinese data. I'm not as nervous about the Washington policy. I'm very nervous about Chinese data, and that's why that bond market and that inflation deflation issue really elevates and puts me in a different perspective of wanting to get prices protected if we lose technicals.
Mike, always great to talk markets with you. If folks want to reach out, take a look at your analysis, have a conversation, how can they reach you there at Global Commodity Analytics?
Globalcomresearch.com is the website. Call me toll free 866-471-2588 after the market closes if you have a question.
And of course, that risk of trading futures and options can be substantial. We always want to remind folks of that. Mike Zuzolo, Global Commodity Analytics. Good to catch up with you, and we will talk to you next week, sir.
Thanks, Jesse. Have a nice week.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.